Okay, thank you. Okay, I want to start out with an announcement. I'm not going to require the guest speaker write-up. We are kind of pushing here towards the end, I realize, and we have a shorter term, and we had a holiday in there. So, with all that, I think the smarter thing for us at this time is not to require you to turn in the guest speaker write-up. So don't worry about that. I will not base your grade at all on a guest speaker write-up. Okay, any question on that?
Obviously, we're not having the guest speaker at all either, then, right?
Yes, that's correct. For this class.
Yeah, got you.
Yeah. Okay. Anything else? Any other question? Okay, good. Then let's go ahead with that and let's take a look at our chapter 4. And the game plan for tonight is to complete chapter 4 and hopefully get into part of chapter 5. And I really, really hope we can do that, because the way they organized information for the discussion of internal control communication, they put part of it in chapter 4 and part of it in chapter 5. I think they should have put it all in one chapter. So I'm really hoping that as we're wrapping up chapter 4 and talking about internal control communication, that we will have sufficient time left over to get into the discussion that really continues in chapter 5, and probably they should have decided to put it all in one chapter or the other. Okay, so you'll see as we go along, and I'll explain what I'm talking about a little better when we're looking at that material. So I'm going to go ahead and put us in full screen mode here, and go ahead and put my computer in laptop mode. Okay, and let's go ahead and pick up with module 6, which is, by my recollection, where we had left off on Monday. Now, remember Monday we were talking about various transaction cycles, and we were saying that the approach for the transaction cycles was really to focus on the assertions. So we're going to continue to discuss these transaction cycles by assertion, and there's pretty much of a consistent approach across the different accounts when you're talking about various assertions. Property, plant, and equipment, and remember I said that property, plant, and equipment was a medium level number of questions that you would get regarding the transaction cycles. I said total 30, and then I called out revenue, expenditures, some of the ones we've talked about already, heavy, investments, light. When we talk about financing transactions, those are light. Property, plant, and equipment is medium, but it's worthwhile for us to spend some time looking at this, because you can understand how to audit the assertions, even if you're not talking about a physical item such as property, plant, and equipment. If you understand how to audit the assertions for the property, plant, and equipment account, you can apply that understanding to any account that might be a little more esoteric for you. Say, for example, if you were thinking about steps, procedures for revenue. So as we go through and we start to talk about these now, we are, okay, I'm going to get distracted by, we're not muted. Okay, so let's just go ahead and mute folks. Okay, all right, good. So what happens? We sit here and we start to talk about property, plant, and equipment. Now, what happens when we look at the property, plant, and equipment, we start out, as we do with all the cycles, we start out with the internal control, and we talk about the separation of duties. So we talk about acquisition, okay? Acquisition, and notice that they say for acquisition, we have to provide the reason for the acquisitions, amount of the charge, probable cost, and it's approved by top management. it's approved by the board of directors. So when you start talking about larger ticket items such as purchases of investments, financing decisions, these type of things, we tend to bubble those up in terms of approval all the way up to the board of directors. Okay, now remember, we said we're going to separate authorization, record keeping, and custody, right? That's why we have these different individuals, departments, boards of directors involved in these transactions, right? To separate authorization, record keeping, and custody. So what do you think? Is this an authorization, a record keeping, or a custody?
Authorization.
Good, excellent, sounds good. Yeah, I'm gonna put an A there for authorization. Good, okay. Then we start talking about subsidiary ledgers, okay? And subsidiary ledgers contain detailed information, giving you a description of the asset, the location, etc. What do you think this is?
Record keeping.
Good, excellent, okay. And then we start talking about physical security over our fixed assets, such as a serial number plate, safeguard the assets, such as physical controls, such as, well, they don't say it here, but, you know, things that would safeguard from theft and destruction. I thought they were going to talk about those. You ever seen those? They look like a cable that's kind of connected to the asset so you can't carry it off. This is going to be what?
Custody.
Good, okay. So we separate those three, right? Now, they give us here a really good thing that I want you to flashcard, and it's really describing an internal control for us, okay? So comparison of the serial number on the identification plate to that listed on the control account should be made, okay? Now, management can do this periodically as an internal control, and then the auditor is going to make sure that that is happening and that there are the appropriate safeguards in place. So you might observe if management is reconciling that periodically, or look for some sort of record that shows that they went out and did their reconciliations, and then the auditor will look and inspect those assets and see that they're properly locked down, that sort of thing, okay? Good. So go ahead and flashcard that particular step of internal control, because that's a pretty common one that the examiners like to ask about. Okay, flashcard that. Now, disposition. If we are going to dispose of an asset, if the entity is, then there should be proper segregation of duties between the authorization and the custody. So if you're disposing of an asset is somehow being removed from the premises because it's been sold or whatever, then there needs to be the proper authorization that's separated from the person that would actually do that physical work of removing that asset. Okay, and that again is internal control, separating authorization from custody. Okay, all right, good. Now we go over and we start talking about procedures. And again, I think they could do a better job calling out the fact that we are talking about substantive procedures. So they do that, at least they make that annoying mistake consistently that they don't call out that they're talking about substantive procedures associated with the various assertions. So we first start talking about completeness, and they say select a sample of actual fixed assets, say this mouse, and they go and they take it back to the accounting records. That's completeness. That is consistent what we've said about completeness for every single account now, and we're continuing to apply that to our property, plant, and equipment. Okay, let's take a look at existence. And when we deal with existence now, what happens? We go and we inspect first. Where's my existence? The auditor should inspect the actual asset. Okay, so what happens? The auditor should consider selecting older fixed assets from the subsidiary ledger and then locating those as a mean of testing unrecorded retirements. Now, you know that we're talking about the existence assertion But when we use the word unrecorded, what do you generally think about?
Completeness.
Completeness. If something isn't recorded that should have been recorded, then we have a completeness issue. But we're under here talking about consistency, because if it's unrecorded retirement, existence, excuse me, if it's an unrecorded retirement, then what? Something that should have been removed from the books was not. That's an existence issue. So you would go and find things that look like they've been around for a long time. Let's see. You acquired this asset in 1974, and your accounting records are saying it still exists. I'd like to see that, because by now it's practically an antique, right? And then you go to look at it, and guess what? It's not there. So you just did what? An existence test, even though we're using the word unrecorded here for unrecorded retirements. Okay? Question. Okay, good. And then rights and obligations, if there's been any kind of, if there's been any kind of pledging of an asset, whatever, that would be the rights and obligations assertion. And we would expect there to be some sort of footnote disclosure that's saying that assets have been used as collateral, etc. And you could also, oh, that's a good, I think we'll get to that other point about collateral when we get to the disclosures here in a second, disclosure assertions here in a second. But this, I'm asking you a flashcard, because even though you can see the asset is listed on the financial statement, you go and you find the actual physical asset, right? So you confirmed its existence, but maybe they don't own it. Maybe they just rented that. So for rights and obligations, then you're going to have to do another procedure, which is to look at the invoices, titles, deeds, whatever, to show that they actually have ownership of that asset. Okay. Okay, good. Now we come over, and when we talk about our completeness assertion now for transactions, okay, and here we say that the auditor should also review the repair and maintenance account, and you're looking for things that were listed as a repair that should have what? That should have been included in the fixed asset account. So if they tell you that they capitalize any repair in excess of $5,000, then you would look in the repairs and maintenance account. If you see a transaction there for $5,000, now you're saying, well, wait a minute, why was that $5,000 booked in the repair and maintenance expense account? It should have been in the fixed asset account. Okay. Okay, good. Valuation and valuation, allocation, accuracy. What's the mantra that we've used every single time we've seen those assertions? It's been recalculate. Okay, so what happens for depreciation? You need to recalculate and see if you are satisfied with the way they did the depreciation. Okay, okay, good. Coming over, understandability, classification. Again, you may want to look at the repair and maintenance. That's really getting to a classification issue. Did they put something in the expense, repair and maintenance expense, that should have been capitalized? Okay. And then when you talk about presentation and disclosure, the depreciation methods that are used, etc., useful lives are the type of things that you might expect to see in the disclosures. Liens, mortgages associated if you've pledged the asset as collateral or whatever. Okay. Okay, good. Now again, guys, I think that it's easy for you to visualize how you would audit the property, plant, and equipment, but the thought process that we talked about there could be applied across any of the different accounts that we've been talking about, because we're focusing on the assertions. Okay, good. Let's go ahead then. We're going to jump into our first question here, which is going to be this one. And I'm going to go ahead and put the poll up. Okay, good. Let's go ahead and let's take a look at this one. Looks like everyone's had a chance to give it a shot. And okay, we got a good percentage getting this correct. And I would have thought this would have been a little closer to 100% because we really kind of talked about this question indirectly during our discussion. So please make sure you're following along with the discussions, okay? But let's go ahead and let's take a look at this question in performing a search for unrecorded retirements. If it's unrecorded retirements, what assertion?
Existence.
Its existence, because we're looking for the situation where they should have taken something off the books and left it on the books, right? And so they tell us in A, inspect the property ledger and then tour the facility. Well, look, if something's sitting on the property ledger and it was what, an older asset, and then we toured the facility, we would find that that old thing is either a hunk of junk now, obsolete, or no longer on the premises. So we would have found the unrecorded retirement by doing item A. Now, I find this sort of a silly distractor. I mean, insurance and tax records. I mean, probably the first thing you're going to do when you retire an asset is what? Take it off of your insurance and not want to have to pay any more property tax on that thing, if that's the tax records that you're talking about. So those are just distractors, okay? The key thing is what? Tour the facility and go and try and find this old thing, okay? Now touring the facility, B, and then going back to the item, that's completeness. No, it's existence. Analyze the repair and maintenance account and then tour the facility. I guess if you're bored, you might do this. I don't know, analyze repair and maintenance account. You see something in there for $5,000 and you think it should have been capitalized, so you're gonna go find this thing now. This would be a waste of time, I think. Tour the facility and then analyze the repair and maintenance account. To do what? Oh, okay, here's this thing. Let me see if they booked something in the repair and maintenance account for this thing. Okay, so again, guys, with your fixed assets, you should really look at, when you're understanding these questions, and really look, imagine you're doing this, because it's not hard to picture yourself trying to find the asset and all that and say, well, how would that help me with the objective of what they're saying here, which is looking for unrecorded retirements under the existence assertion. That's the kind of thinking you need to really start to build up some muscle tissue on to help you get through questions, because the exam in itself, the concept of auditing in itself is not that difficult, but the way they write some of these questions is what really, makes it halfway challenging. And then once you kind of get used to sparring with the way they're writing things and whatnot, I'm here to tell you that I don't see that you will have a problem with the auditing exam. I don't think you're going to run into time constraints on your auditing exam when you're taking it. You're going to be in good shape going in when you take your test, okay? Okay, good. So let me quickly do something here. I need to, it was funky and cloudy all day. And then as soon as I start my class, when I prefer the sun not be shining in my face, here it comes. Okay, so anyway, let's just go ahead and let's stop whining and let's turn the camera back on and let's go ahead and go to our next cycle, which is payroll. Now, I can't explain to you why Becker chose to sort of bury payroll in with this big old other transaction cycles, other than their desire to put things contain things inside of modules, because payroll is a heavy cycle on the exam. Okay, so some of the other heavy ones had their own module. Here we've kind of buried it in with this other, but payroll is heavy, and the reason payroll is heavy is that almost every entity has a payroll. Now, the thing that's interesting about payroll, though, and you see here in the beginning here, is that we're worried about the creation of fictitious employees. So when we look at the internal control, we're going to try to separate the what? The authorization, the record keeping, and the custody, so that the main thing that we don't hire a fictitious, a fake employee, and then that person starts getting paid, right? We don't want that, okay? So when we start to look at the segregation of duties, notice the authorization to employ is the human resources. So that department, that's an authorization, okay? Then what? Then we have supervision, and supervision, and the supervisor is custody. Now, that sounds a little crude because we don't sit there and you know, cuff ourselves to the person, but supervision is a custody issue. Okay. Then we have what? Then we have timekeeping. That's obviously what? Record keeping. And then payroll check preparation is a record keeping function, right? And then the finally payroll check distribution is considered custody. Okay. Now the way they describe this payroll check distribution thing harkens up images of 1964, okay, where you'd have, people working hard and someone walks out on the factory floor and hands them a check and says, thank you for another hard week of work. Meanwhile, these days, what? Everybody is on direct deposit, okay? So we're going to see that in a couple of minutes, we're going to look at some steps that will help you to get comfortable that the direct deposit process is working correctly. But on occasion, the examiners like to ask you a question about payroll check distribution. That's a custody function, okay? So we're going to separate those things, and then we take a look and notice that the auditing department, internal auditing department, periodically should make sure that personnel files and match with the payroll, right? So again, making sure, you can flashcard that, making sure that that internal control is functioning, because again, we're trying to avoid what? Fictitious employees. So if someone's receiving a check, were they appropriately hired? Did they go through the hiring process with the human resources? Okay. All right, good. Let's start to take a look at some of the internal control steps now that the auditor will do. Okay, let's flashcard these. Okay, so again, we're worried about fictitious employees. So observe segregation duty between human resources and payroll. Compare the personnel records for each department with the actual time card. So if someone's punching a time card, they should be they should be personnel file for them. They were really hired. Observe payroll distribution, and they say on an unannounced basis. Payroll distribution is one of these things that, it happens rarely these days because everybody uses direct deposit, but it is still a step that, the examiners may very well ask about. Okay. Coming down a little bit, observe the use of time cards, investigate any time cards that aren't being used. Again, idea, they've hired a fictitious employee. They see that the auditor is sniffing around and they stop doing that for a while the auditor is there hoping you won't notice and go away. So if you see some time cards that aren't being used, okay. And then finally, our procedures moved into the 90s here, and that if direct deposit is used, then what you'll do is you will basically look to see that there was a direct deposit authorization. You can look at how that's filled out, the information that's filled out there, and compare that to the employees fill out of their W-4. So when they first come to work, they're going to fill out a W-4. They're going to indicate different things on that, and you will be able to see that they also at that time filled out the direct deposit authorization. Then you'll see the bank account number that's on there. And then you can look and see that when they make the distributions through the direct deposit, did that actually go through to that bank account? Okay, so you've got the what? You've got the personnel records, you got the W-4, you got the direct deposit authorization. On the direct deposit authorization, they're going to say what bank account they want that to go to. And then when the actual distribution comes out of the payroll account to the various bank accounts where it's deposited, you can look and see. You don't have to do 100% on that. You could do on a sample basis. You can look and see that that got deposited. With data analytics software, you may be able to quickly do 100% testing on something like that. That's what these data analytics software are all about. Okay. Okay, good. Now they tell us that we need to test both general and application controls. General controls are things like password use. Application controls apply to a particular application, the payroll application. You should test both of those. Okay. And then coming down, that's our internal control evaluation flashcard, that specific procedures. It's a little annoying because internal control procedures are still further audit procedures. So if you're doing some internal control testing, that's still a procedure. So I get a little annoyed, and maybe I'm just being too particular, that they should indicate to us that here we're talking about substantive procedures. Okay, so when internal control over payroll is effective, the auditor generally focuses substantive procedures on analytical procedures and recalculation of payroll accruals. Okay, flashcard that, just flashcard it. I don't know that they can ask you a question like that, but this is a good thing for you to think about, because then it points to the nature of the procedures that are going to be coming, because payroll lines itself up beautifully for an analytic procedure. How many employees do you have? What is your average pay on those employees? Or you could do it by category of employee, whatever. And that then should what? That should come out to about what the payroll should be for the year. It's not like people sneak in and all of a sudden start getting paid. And if they do, that's the kind of thing we want to find when we're auditing our payroll. So you can do an analytic and maybe do it by category of employee, average pay for that category of employee, do the extension, compare that to what the payroll expense is for the period. You've got yourself a nice little analytic there. Okay. Now they do talk here, although it is not something that is generally done, about procedures over specific transactions, and we'll get down to those here in a second. But let's just take a look at a couple of things here. Tests related to completeness, existence, rights, and obligations are generally performed only when the entity's internal control cannot be relied upon. So when we start getting into here on some of the transactions, that's assuming we're trying to lower that detection risk because we identified some poor controls. Now, we said that you're primarily going to do an analytic procedure, and you're going to do what? Test year-end accruals. Okay, that is something that you would do a procedure on, which is to make sure that if the year ends on Thursday and we don't pay until Friday, then you're going to have to do what? You're going to have to accrue the liability for payroll payable, right? And then you're going to obviously have to, that would be the credit, you'll obviously have to debit the payroll expense, even though they haven't paid that yet. Okay. Okay, good. Now when we deal with transactions, and again we tend to do that transactions when the controls are weak, and you start to take a look here, and the auditor should trace a sample of time cards to the payroll register. So if somebody's getting paid, or I should say if somebody worked and they punched a time card, then the payroll register should reflect the pay completeness. Now the supporting documentation going to the accounting record, supporting documentation is the time card, right? And then going the other way for existence, the auditor should vouch time in the payroll register, and then go and find the time cards with that. Okay, so that again goes the other way. Okay, valuation, allocation, accuracy, and they kind of point to, even though they're talking about transactions here, they really point to something that could have been more up in the account balances discussion, because this is an analytical procedure, guys. If you compare what the year-end balance is to what the budgets were, that's an analytical procedure. Okay, so when you look at payroll, it's a pretty easy thing to audit, isn't it? Hey, make sure they have control so we don't have any fictitious employees. And then what? Do a few analytics that will help to see if what the number of employees you determine is appropriate times the average payroll. And again, you could do that by category. You're going to then do the extension, analytical procedure, compare budgets to actuals, maybe is another analytic. If you feel that you've got some issues there with the controls, do yourself a completeness and existence test and get the heck out of there, right? Okay. All right, good. So let's just go ahead and let's take a look at this question 2. What am I doing? Poll, right? Okay, good. Let's take a look at this one. And again, when you start getting into specifics of procedures like this, I want you to go ahead and visualize that you're doing what the question is telling you and see if you think that it then meets the objective that was shared as the answers here. Okay, so most of us got this right, but let's go ahead and let's just take a look at this from the bottom up. Let's do that. Okay. So it says an auditor vouched data for a sample of employees in the payroll register. So you have a payroll register, and the payroll register says this is the amount of hours that people work. This is what they make per hour. This is what we were supposed to pay them, their gross pay. Okay. And so the auditor took a sample of people from that payroll register and then looked to see that they punched a time clock. So what piece of information in that payroll register would be validated by looking at the time clock? Punch, the time card date. Huh?
Hours worked.
Hours worked. Okay, it's going to tell me that what? That the employees worked the number of hours for which they were paid, right? Which mostly got that right. Will it tell me anything about the rates? No, time cards don't say, hey, I make so much per hour. Okay, time card just says, hey, this is how much was, how many hours were worked, right? Okay, how about C? Segregation of duties exists between the preparation and distribution of the payroll. How will that procedure tell you that? It said nothing about looking to see the ID of the person that the check was distributed to. It said nothing about looking at direct deposit. It said nothing about looking at who prepared the payroll records and making sure that they weren't the same person that distributed the checks. Come on, guys, visualize and use your, you're born in the generation of, Mickey Mouse and the Roadster Racers or something, weren't you? So picture all those things that they've been showing you ever since you were a child.
I like Little Bear and Franklin.
Imagination. Huh?
I said, no, I like Little Bear and Franklin.
Little Ben Franklin?
No, I said Little Bear and Franklin.
Oh, okay. Maybe I went too far past. My friend's son loves Mickey and the Roadster Racers, so I'm sitting there, Mickey and the Roadster Racers all the time. So anyway, okay, but they've worked hard to develop that imagination for you, haven't they? Okay, so use it. Okay, D, internal control relating to unclaimed payroll checks are operating effectively. Now let me see. The person worked, they got paid, there was a check that was issued to them and they didn't claim it. How will you find that? By looking at the payroll register and comparing it to time cards. I mean, they're putting stuff in the, let's say it's a fake person. They're putting it in the time card, they're getting it in the payroll register, but it's, some imaginary person here that's getting a check. And if there's unclaimed checks, well, maybe the person waits till the person that perpetrated this whole thing is waiting until nobody's looking, and that unclaimed check that keeps coming for that fake employee, they kind of grab it when nobody's looking, right? So you would want controls that if there is an unclaimed check, that's being properly secured in a safe or something like that. And there's a procedure, maybe by the internal audit department, each payroll cycle, maybe every 2 weeks or something, saying, were there any unclaimed checks? We'd like to see what those unclaimed checks were, and they're following up on those. But that procedure will not give you any sense as to that internal control, obviously. Okay, question? Okay, keep trying to picture yourself doing these things, guys. Pretend, and by the way, this applies in the real world when you're doing an audit. If your supervisor says to you, okay, go over there and look at the payroll data, hurry up. You slow the roll and you say, okay, do I understand why I'm doing this? Why am I doing this step? And if you don't understand why you're doing this step, you are well within your rights as an emerging CPA, as an emerging auditor, to go back to your supervisor and say, are we doing this because we're trying to determine if the employees worked a number of hours? Okay, good. If you don't know why you're doing a step, you're not doing your job. You have to know why you're doing that step. What am I trying to prove by doing it? And you want to start to get your thinking going that way. That's how you become a good auditor. That's how you develop the understanding that then when people start describing things to you, even, you start saying, that doesn't sound like a very good internal control to me. Is that really what you do? Then you could follow that weak control to the finding. Okay, so you want to make sure you're understanding why you're doing those procedures, and that's going to help you to be, be better at your job as an auditor. Okay, good. Let's come over and let's talk about financing cycle. Okay, when we talk about financing, companies generally have what? Debt and what? Equity financing. And so when you look at the discussion here, that's what we're doing. We're looking at how the company is handling, I don't know why I had to write it again there, but that's why the company is talking about, we're looking at how the company is financing things through debt and equity. So we start to take a look, and you can see that that's how we've sort of separated the discussion here, debt versus equity. Okay, now we look to see that there's authorization of new debt. And look, if you're going to encumber the company with debt, That's got to be at a high level of the organization board of directors. Okay. Internal controls over equity. Again, if a company is going to issue ownership of the company, then we're going to be looking at high levels of the organization board of directors. So I think I'm going to ask you to do a little dictation flashcard here for me. Okay. So let's just go flashcard here. And the flashcard is going to say lots, L-O-T-S, as in lots of board of directors authorization for, let's go ahead and start with financing here, since we're in the financing cycle here, financing. But also, if you look back at investments we talked about last time, you saw board of directors, board of directors, board of directors all over the place. And what? And large dollar amounts. And I want you to put in here, e.g. equipment. Okay, so notice it says e.g. equipment. So let me read that back to you. I know that's hard to read. Lots of board of directors authorization for what? Financing, investments, and large dollar amounts items, e.g. Example is equipment. Okay, notice we didn't say we have to go to the board of directors every time we hire a clerk. Okay, that was what the human resources was more involved in the authorization. Okay, good. And so they tell us for our equity now that many large entities use stock transfer agents. So you hire somebody to issue stock for you when stock is being issued, okay? And they will make sure that stock is issued in accordance with the articles of incorporation, et cetera. If a stock transfer agent is not used, the entity should implement the following controls. So let's go ahead and flashcard those controls. And you can write the flashcard just like that. If an entity does not use a stock transfer agent, what would be some controls? Flip the card over. And the answer would be that the company should maintain a stock certificate book that'll show that stocks were issued, et cetera. And in order for there to be proper separation of duties, the stock certificate book would really be seen as the custody, and then recording those issuance of stock would be the accounting responsibilities. Again, separating the custody from the record keeping. The best way to separate that, of course, is to have a stock transfer agent, okay? And then the next control that you should be flashcarding, and I'm saying flashcard on top of flashcard, make the statement on the blank side, and then these are the answers to the question on the line side of the flashcard, which is there should be a reconciliation between the stock certificate book and the number of shares outstanding. And when they say independent, that's by someone different from the record keeping and the custody. So that becomes almost an authorization step, but that's really done. You can include on the flashcard. Internal audit staff is a good group to do something like that. And you would be looking for those controls. Okay, good. Procedures. What kind of procedures are we talking about here, do you think? Substantive procedures. Internal control procedures are also procedures, but they don't want to seem to call out the word substantive procedures here, but for debt. Okay, and notice we put completeness first, and we say all new debt contracts need to be taken back to the financial statements. Okay, also notice that any debt disclosed on the bank standard confirmation form should go back to the financial statements. I don't know if you've noticed a pattern with the way I describe this stuff. When the book calls out the word trace and the book calls out the word vouch, They are generally using trace for completeness and vouch for existence. Don't memorize a word. Don't memorize vouch and trace and think that you're always going to get the right answer, because the examiners are not nearly as consistent in using that as Becker is careful to be, or as a textbook is careful to be. So understand what you're doing. If we're talking about completeness, I'm going from the supporting documentation back to the financial statement. So in this case, the supporting documentation would be that standard bank confirmation form that we sent to all banks, whether there was a balance to confirm or not. And I think it was like the second question on that example form we had. It says, were there any loans outstanding? That's a completeness test that you're doing what? For over debt. And you take that then, if there's something listed on that bank confirmation form, and you make sure that indeed they were listing that as an outstanding debt at the end of the year when you're doing your audit, right? For your audit of the financial statements. Again, you kind of went hunting for that, right? You sent the bank confirmation form, and that's over the existence of cash. But then you kind of snuck in a completeness test for debt down there by asking that question. And then you would, of course, if there was something listed, make sure it was properly recorded. Okay. Okay, good. Valuation allocation. Okay. And we say here that the auditor should recompute any interest payable. Recompute, okay, is another way of saying recalculate interest payable. And the best way to do this would be to get comfortable with the outstanding debt balance, and then do what? An analytical procedure that would apply some sort of average interest rate, whatever, to the outstanding debt, and see if that's showing up as a payable. Okay. And of course, you'd have to do some calculations there to say, well, they issued this debt on July 1st and it was been outstanding for half the year, et cetera. Once you get the point is, once you get comfortable with the debt balance, you can usually leverage off that to do a recalculation of the interest payable, interest expense as well. Okay. Okay, good. Now you come over and we mentioned auditing now debt transactions themselves, not the balance, and just looking at completeness, and look at payments that were made for interest expense to a creditor that then wasn't listed as an outstanding debt. How come you making interest payments yet we don't see the actual debt that interest was being generated by? And so you can go ahead and flashcard that step. Okay. Okay, good. Now you come down and let's take a look at completeness of our presentation and disclosures. And for a lot of the presentation and disclosure thing, guys, notice I kind of just went real quickly, highlighted one or two things and didn't ask you to flashcard. Here I'm asking you to flashcard this: restrictive debt covenants. Restrictive debt covenants. What happens? Often a debt agreement will come with the stipulation that if certain debt to equity ratios fall out of whack, then the debt is immediately payable. And sometimes creditors will require that as a protection to themselves, that if the debt to loan ratio or whatever, get out of the value to loan ratio for a particular loan, get out of whack, they can call the debt immediately. And so that's something that would absolutely need to be disclosed in the footnotes. That's a material important footnote disclosure that I want you to flashcard there. Okay. And then you come over and when we're talking about equity, if the stock transfer agent is used, you can go ahead and confirm with them the number of shares authorized, issued, and outstanding. You can go ahead and flashcard that. On our balance sheet, our client's balance sheet, they have to call out the number of shares authorized, issued, and outstanding. That's a piece of cake. If they're using a stock transfer agent, you've got a third-party verification of that. You just ask them to provide that information, and you compare it to whatever the client has disclosed on the financial on the balance sheet as to their shares authorized, issued, and outstanding. Okay, and then understandability and classification for our stock transactions, and the main thing would be if there were any restrictions on retained earnings. If there were, then that should probably be called out as appropriated retained earnings. So that's really getting into a good classification, unappropriated versus appropriated retained earnings. Okay. All right, let's take a look and see what we have here. And yeah, we're going kind of quick through these. I understand, because again, remember, these are lighter cycles. Okay, so I just want you to make sure that you are getting some good flashcards around this, memorizing those cards. If you see a question in your homework that I didn't ask you to flashcard in this area, just add that flashcard. Don't spend hours and hours figuring out how to audit the finance cycle, how to audit the investment cycle, when the examiner is going to ask you 1 or 2 questions on that. So that is an area where flashcards become critical, because you don't want to get into the world where, you know, those little things gang up and kill you. You attack those by having flashcards, a good set of flashcards that'll get you the key points around those. Okay, let's go ahead and take a look at this one. Okay, and most of us got it right. The answer is C. Okay, so let me ask you this. Most of us got it right. Answer is C. But let me ask you this. Let's say I told you that a company had 10, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, $10 trillion in bond debt. And then I told you that their bond interest expense for the period was $5. Would you be suspicious?
Yes.
Okay, now let's compare that. The auditor would most likely. Let's compare this to other things. Perform analytical procedures on bond premium and discount. Go ahead, give me an analytical procedure on bond premium and discount that will give you the reasonableness for the bond payable. I can wait.
I don't think there is one. I'm the only one that chose the answer. I don't know why I chose that. Now that I look at it in that way.
Okay. The objective of this period of time, this 3 hours that you're giving up on this beautiful summer day, or it's not quite summer yet, but it's almost summer, late spring day, is to develop a way of thinking about this interesting profession you've chosen. It's your fault, not mine. Now that part's your fault. You chose this. I didn't come to your house when you were a kid and say, hey, study accounting. Okay. All right, good. So that's what we're doing here. So that's okay. But that's what's happening right now. That pain you feel is the weakness leaving your body as you understand better. Okay, yeah, there's really not an analytical procedure that I could really think of that would be reliable at all. They would say, okay, well, if you have this much discount, this must be your bond holdings. If you have your outstanding bond payable, if you have this much premium, this would be your outstanding bond payable. There is no analytic because bonds sell above and below face all over the place, right? Depending on what's going on with market rates. So I can't really think of a good procedure there. How about examine documentation of assets purchased with bond proceeds for liens? Well, look, that might be a good disclosure step over the property, plant, and equipment account, but it's not something the auditor would most likely do for a bond payable. Okay, and then D, confirm the existence of individual bondholders, and that's where the most likely comes in. What assertion are you worried about if you are doing confirmation? Oh, never mind. They're talking about existence here, right? They tell us existence. Is existence the most worrisome? I'm making up words. The most worrisome assertion for debt for bond payable?
No.
The most worrisome assertion is what? Is completeness. Okay, when you start getting to completeness, you start finding yourself doing stuff like this, saying interest expense is not complete if they have sat here and, you know, told us, try to get us to buy into that the bond interest expense is only $5 on $10 trillion of debt. So if you got comfortable, and by the way, this wouldn't give you much, confirmation wouldn't give you much comfort with completeness. Could give you some comfort, but remember we said that when you do confirmation for debt, you're supposed to use what? You're supposed to use blank positive confirmation so the client's customer goes and looks through their records. But even that, if I was following up on your audit and you told me the only procedure we did, John, was we confirmed the existence of debt holders, and that's all we did over the bond payable, I'd say, well, guess what? You didn't do enough work over bond payable. Go back and do another procedure, something like this, or look for a subsequent year-end disbursement and take it back to the actual bond payable amounts, etc. Okay? Question? Okay, guys, you gotta keep doing that and thinking through the steps, okay? We're done with the transaction cycles. Transaction cycles, 30 points. You gotta develop that part of your brain to get you comfortable with thinking that way so that you're doing a good job on those questions. Okay. All right, good. Opening balances, guys. Just look at the questions for that particular area. I'm not going to get all off into these procedures here to make sure you're comfortable with the opening balance. There's nothing that's that difficult there, and I find that discussion a bit mind-numbing, and so I want you to just go ahead and look at that on your own, okay? Let's go ahead and let's just take a look at litigation claim and assessment now. So what happens here? We have a, before I move to this, I don't feel I emphasized enough. Did I emphasize enough to you how important transaction cycles are?
Yes.
Okay. I felt a little bit something missing there, but good. You got to know that stuff, and you got to develop that thinking. Yes, we can flashcard a few things that come up a lot, but to really be successful on the exam, you got to develop that way of thinking. Okay, so I guess I did say that. Okay, good. Let's go ahead then and let's take a look at litigation claims and assessment. Okay, so what happens? We want to make sure that if there is a potential or there actually is a lawsuit that the companies come under, that is properly accounted for and disclosed. Now, let me ask you something. If you were the CEO, CFO of a company, do you think you would know if you were being sued?
Yeah.
I hope so.
You damn well better, okay? Or you need to step away from that position, right? Okay. And so what happens? The auditor's expectation is they should know whether or not they're being sued. And so what we're going to do is we're going to rely to a large extent on management to tell us about this. Okay. So let's just take a look. And if there is evidence, we want to provide evidence to see what, well, I jumped a little bit here. What the audit objectives are, were there underlying causes for legal action, the degree of probability of an unfavorable outcome, and the amount of range of potential loss. Now, when you read that, that sounds pretty familiar because that's almost coming out of the accounting standards, right? Hey, what is the potential for an unfavorable outcome? Probable? Is it estimable? If it is, we have to book that. If it's not estimable, then we have to disclose a range. If it is, possible but not probable, then they have to disclose the range of potential loss. If it's remote, they don't. Right? So the auditor is trying to make those determinations to see if it's properly accounted for and disclosed, right? Now, to determine if there's potential litigations, claim and assessment, do the following. And the first thing is to talk to management. Again, my point, they should know what's going on, but we will also look at some external documents. For example, are they receiving letters from the IRS? IRS is sending them saying, hey, you have so long to pay this outstanding tax, maybe they're disputing that, et cetera. And so you would ask to review those sort of correspondence. When stuff like this starts happening, people start getting nervous and they want to make sure that the board of directors know about that. So you would look to see if there's any discussion in the minutes of the board of directors about anything. And sometimes those things are written in there in an annoying fashion. I looked at one time where they kept referring to the case. And I'm like, what case are we talking about here? Are we talking about a case of beer? Or was there some, case like a law? You mean a lawsuit? It turned out it was a lawsuit. They kept talking about the case. And then it turned out that there was some inappropriate relationship with a member of the board of directors and one of the employees. And as a result, the CEO resigned because I guess whoever they were having, board of directors having a relationship with, I guess, decided that they were the boss and started trying to push around the CEO. And the CEO said, I'm out. And so once the CEO resigned, that brought on the case and whatnot. But sometimes they're not really clear about what they're talking about with some of those things. And so what I had to do in that case, because it was a credit union, I had to ask the National Credit Union Administration, NCUA, I had to ask them to come in and give me some more perspective as to what was going on, since I didn't have audit authority over the credit union. I was looking at the board directors minutes that were contained in the NCUA's work papers, and because GAO does have audit authority over NCUA, I had to have the auditor that was for NCUA come in and, you know, had to sit down, and he was a funny guy because he says, well, let me give you a little color. And then he started telling me about this relationship and whatnot. And then the finding from GAO's perspective, just to tie out that story, that's probably the most boring story you've ever heard. What we ended up doing was saying that NCUA needed to require credit unions to institute a code of conduct and make sure that, you know, everybody received that code of conduct upon entering the credit union, and then to establish controls to make sure that they were providing training and whatnot. In other words, we recommended something that would affect the control environment, right? And the control environment, and then what? And then we have the, you know, the risk assessment that came. Now they know what the risk is. Information and communication, make sure people understand, put the procedures in place. Information communication, make sure people understand, and then monitor. Is the training and whatnot happening appropriately, right? Okay, and all that, my point at some length here now, all that coming from something that was seen in the board of directors minutes. Okay, so you can sometimes find things like that out. Okay, that's my only point there. Okay, and then obtaining a letter from the client's attorney. That's pretty much going to happen as a matter of routine on every audit, and we're going to get to that here in a couple seconds. Okay, but flashcard those things. The important thing being that management needs to be telling you about this stuff. They know if they're being sued. Okay. Okay, good. So what happens? You come over and you take a look, and the letter of inquiry to the client's attorney. And when audit procedures indicate that there is a actual potential litigation claim or assessment, and again, you might find it through those procedures we just flashcarded on the previous page. They should tell you about it, and they say when this happens, but as a matter of, you know, risk management for the auditor, you're going to have them send this thing to the client's attorney. Okay, you know, you're going to have direct communication between you, the auditor, and the client's attorney. Okay, and so the auditor should seek direct communication with the external counsel regarding litigation claim and assessment. Now, the letter that you're sending is prepared by management. The attorneys are not going to sit there and talk to you because of client-attorney privilege, right? So the letter is written from the client to the attorney asking for the disclosure of these issues, but the letter is mailed and then returned to the attorney by the auditors, okay? So the letter is controlled really by the auditors, okay? And if there is in-house legal counsel, then you're going to have to ask the client to allow you to speak to that in-house legal counsel. Okay. Now, the auditor should document the basis for any decision not to seek communication with legal counsel. Okay. So notice when the auditing standards start telling you to document why you didn't do something, what do you think that's telling you?
It's very, very important.
It's telling you to do it. Okay, because the difficulty of explaining why you didn't do something is too much. So you just go ahead and do it. Now, if the client refuses to permit inquiry, that will result in disclaimer of opinion or withdrawal from the audit. So again, because lawsuits are these things that could be flying around out there, and you don't really want to just rely on the client to tell you about them, your best bet is to do what? Make the determination that you need the letter. And if the client says to you, no, we don't want you to talk to the attorney, your best bet is to say, hey, I determined that I need it because I don't want to explain why I don't need it, and they won't let me. I'm going to disclaim an opinion or I'm going to withdraw. And you tell the client that. And at that point, the client's probably going to say, okay, go ahead and send them the letter. So you see how the way the standards are written, but they're written in a manner that's what? Moving you closer and closer to what they really want you to do. They always leave a little wiggle room because there could be some weird situation where you're not going to want to inquire of the attorney, but that's very rare. And so they run you towards the prospect of doing this, of sending the letter. Okay. Okay, good. And again, the attorneys send their reply directly to the independent auditor. Okay. Okay, good. Now you come over and they don't have to tell you every time they talked to the client. Okay. What happens? An employee gets fired. And the employee says, I'm going to sue you as they're walking out. So your client gets a little nervous and they call the attorney. And the attorney says, well, generally with these things, company, nothing bad happens. The person's just upset. They're going to probably go find a better job than they've ever had, and you'll never hear from them again. Okay? Well, the attorney doesn't have to put that in the letter because they didn't dedicate substantial attention. Now, if the employee comes back and they file the suit and we start taking depositions and whatnot, then the expectation is, yeah, the lawyer would put that in the letter. Okay. So it's to matters that the attorney has dedicated substantial attention to. Now, you could limit it to materiality, something that's material, but that requires a meeting of the minds between the attorney and the auditor as to what constitutes something that's, financially, quantifiably material. Okay. Now, there's also confidentiality limitation. And the confidentiality limitation is that the attorney doesn't have to put anything in the letter that they think that if they put it in the letter and then you start wanting the client to disclose that and the client is compelled to disclose that, the disclosure will bring the lawsuit. So they've consulted with attorney on a substantial basis about the potential of violating a patent, I think is given here as an example. And so you go ahead and they put in the letter, you want that disclosed, there's a potential violation of patent. Somebody picks that up and goes, I knew they violated our patent. They're worried about it. Let's go get them. And so the attorney doesn't have to put that. Okay. Now, the refusal to respond by the attorney. Okay. If the attorney refuses to respond, then that precludes an unmodified opinion. So we're going to have a scope qualification, qualified, or what?
Disclaimer.
Good. Excellent. When are you taking that auditing exam?
I need this class's credit in order to sit for it first. So
Well, you're about ready for it. You're about ready for it. You need to get that registration done, get in there and take this test. Okay, so qualified or disclaimer. Good. Okay. All right, good. So flashcard that. Now, I think this would be ridiculous. This attorney is not worth their pay. Because if I'm an attorney and my client says, well, I got to get this letter, and I'm going to tell, what should I do? I'm going to tell the client, as now the attorney, I'm going to tell him, have him send a letter. I've got what, substantial tension limitation, I got confidentiality limitation that I can go ahead and invoke here, so don't worry about it, and therefore they don't cause this trouble of refusing to respond. So it's a very routine process, really, where the attorney responds to the letter and you get that back. So again, you know, they cover every possibility here, but they're really talking about a very routine set of procedures here. Okay. All right, good. Now, inherent limitations, and in some cases, uncertainties make it difficult for the attorney to form conclusion regarding pending litigation. If that's the case, then the auditor would expect there to be the appropriate disclosure of such uncertainty. We don't know what the range is, et cetera. What are you going to do? That's within the standards, the accounting standards there for them to disclose that properly. And if they do, the auditor does not have to modify the opinion. You don't have to give a qualified or adverse opinion because they follow the rules. They tried to make the estimate, couldn't make it, and they disclosed that. Okay? Okay, good. Any question? Okay, good. Let's take a look at question 1. Assuming I can get the poll. Okay, guys, let's make your selection here.
In the updated version that we all got, they did take away the opening balances paragraph.
Oh, did they?
Mm-hmm.
Oh, good. Don't look at it. So if you're doing 4.0 version, there shouldn't be any questions on that, so you shouldn't have to look at that.
Hi, Professor. I have a problem to submit the result. It says it submit a failure. So I need to log out and log back in.
Okay. Okay, good. Let's end this poll. Okay. So, okay. 40% of us got this right. That's not good. We want to be more towards 75. So let's just go ahead and let's take a look at this one now. Let's look at this one from the bottom up, okay? And sometimes I look at this and I think these were put together by comedy writers, okay? So which of the following is an audit procedure that an auditor would most likely perform concerning litigation claim and assessment? D, confirm directly with the client's attorney that all litigations, claims, and assessments have been recorded or disclosed. Okay, so let's see how that would work. I'm going to send the financial statements to the attorney and ask them to look through all the disclosures to see that all litigation, claim, and assessment, even those that maybe have a confidentiality limitation, et cetera, have been reported. The attorney's going to tell me, anything else? You want me to make you a sandwich too while I'm at it? I mean, you don't send the financial statements to the attorney and say, hey, do this procedure for me. No, that's nonsense. Okay. C, discuss with management. Okay. Who's supposed to know about litigation, claim, and assessment that's happening to them? Should the CEO, CFO know if they're being sued? Yeah. And so we would want to say, well, how do you make sure that you've disclosed everything that's going on? Oh, well, anytime there's a lawsuit filed, we talk to our legal counsel, we bring in the controller and discuss the disclosures, et cetera, that should happen, whatever, however they make sure that they're all in there. That seems like the kind of thing I'd want to know about in this area. But let's say I was suspect to C and I wanted to look at B. Examine legal documents in the client lawyer's possession. Go ahead, try that sometime. Call an attorney and tell them to give you their work product. Request the client's lawyer to evaluate whether the client's pending litigation indicate a going concern problem. Really? The attorney's going to look at you and say, I went to school to be an attorney. You went to school to be an accountant and determine if there's a going concern for a particular company. Okay, so again, they put these things in here. You got to read them and you got to imagine how they would help achieve the objective of what it is you're doing. And when you look at it like that, guys, all of a sudden the nonsense, even though they put big words around it, the nonsense that's indicated in the improper, the wrong choices here is glaring. Okay.
Those most likely questions tend to kick my ass for some reason.
Yeah, well, that's understandable because you're not, and I don't mean this as a personal criticism, but often candidates don't give the appropriate consideration for the phrase most likely. That means that there could be some things in here that'll sound reasonable, but there's one that is like, bam, you're going to do this. You know you're going to do this. You're going to discuss with management. Okay, so that most likely phrase has pretty strong indications that there are 3 really stupid ones and 1 good one. But if you kind of don't give the appropriate consideration to the implication of the phrase most likely, then you start looking at these and you start giving weight to all these words that are scattered about in these other choices. So when you look for when you see most likely, that's telling you, there's one here that you got to do. That's the right answer.
Gotcha.
Okay, good. Let's take the break. We're about at 6:30 and we will come back at 6:41. Okay, guys, and we'll go ahead and continue on with this module. Resume the recording. Thank you. And let's go ahead and let's take a look at the entity's ability to continue as a going concern. And they tell us here, just let's read here, that in every audit, there is the responsibility of the auditor to determine whether there is substantial doubt about an entity's ability to continue as a going concern. And I underscore the phrase, okay, come on. And I underscore the phrase substantial doubt and going concern here because those words would have to appear in the auditor's report. It will not result in a qualification of the opinion. It doesn't result in a modification of the opinion at all. However, you would have to add, and if it's a non-public company, an emphasis of matter paragraph that is using those words, emphasis of matter, meaning that it has to be properly disclosed. So the company has responsibility to disclose going concern issues. And then the auditor would have the responsibility of having an emphasis of matter for non-public company using those words. If it's a public company, then it would have to be an explanatory paragraph. Okay, remember we talked about all that back in audit 1. Now, reasonable period of time, let's just use the FASB rule for that, which is 1 year. Okay, what do they say? They don't want to have auditors getting into the business of saying, let's see, I'm auditing an oil company, and you know, these electric vehicles are getting more and more efficient and cost efficient, and I predict that in 30 years, nobody's going to own a vehicle anymore that uses fossil fuels. Now, I personally think that's probably the case. I probably won't live to see it. You probably will, that there will be a day when we'll say, remember when we used to put this explosive stuff into our vehicles and then cause an explosion? And that was how we propelled these vehicles and polluted the air while we were at it. The time is coming relatively soon where we're not going to do that anymore. Okay, so maybe someone will say, well, in 30 years, oil companies aren't going to be quite the giants they are now, whatever, right? Okay, no, you look forward 1 year in making this determination. That's what we mean by a reasonable period of time, okay? Now, you come over and then you start to look at the audit procedures then that would help you to determine if an entity has a going concern issue, and do I need to add that explanatory paragraph emphasis of matter to my opinion, okay? And Becker does a good job here of giving us some nice mnemonics. I would imagine this mnemonic was created by Newt Becker himself, which is the person who invented CPA review, right? Okay, so the auditor will do these procedures. Analytical procedures could identify a going concern issue. Debt compliance, remember we talked about those loan covenants a little while ago and the importance of disclosing those. Why are they so important? Because if it says that they're going to start to call debt, if your debt to equity ratio goes below a certain level, or I guess above a certain level, then if that's the case, they're going to call the debt. And if the company doesn't have the liquid funds to pay that debt, you have a going concern issue. Okay, minutes to the stockholders meetings, they start to describe and talk about those things. Inquiry of the client's legal counsel. They could be talking about, you know, some lawsuits can be devastating to a company. If they have some product liability or something, that would be the kind of thing you might want to talk to the client's attorney about. Other third parties you could talk to, and then subsequent event review. There's some sort of disaster that happens after the balance sheet date. How is that affecting the entity's ability to continue as a going concern? Okay. Then you have fines down here. Okay. And even though they put them into 2 different categories, just remember the whole thing, which is admits fines, F-I-N, or admits fine, F-I-N-E. Okay. So, and you can see how these would influence concern about going concern, financial difficulty, internal matters. Hey, maybe you have a partnership and partner A and partner B don't love each other nearly as much as they used to. Maybe it's a, you know, married couple that is divorcing. These would be factors that would be going concern issues, right? Negative trends, losses period after period, and external matters. Now, The first year that we audited the consolidated financial statements of the federal government, somebody got the bright idea that we had to look at going concern. And this person thought they were going to write their whole career into the head of the GAO. At least we knew they wanted that much. We don't know quite how much more they might have wanted. And the way the guy got messed up was he made the mistake while we were auditing IRS. He made the mistake of trying to sneak out his ex-wife's tax return out of one of the service centers where we were doing work and got busted. And the career went whoop down the drain at that point. But anyway, he was riding high for a while there. And one of the things he came up with was that we were going to do an assignment looking to see if the federal government had a going concern issue. And where were we going to put that going concern paragraph in our opinion on the financial statements. Now, that was ridiculous. I mean, we were seeing the things, negative trends. How about a deficit period after period, et cetera. But the reality is that as soon as you look at the mitigating factors, okay, and that's what I'm leading to here, even though you may see these signs, then the auditor may be able to look to see if there are mitigating factors that will alleviate the going concern issue. Okay, and some things that could alleviate a going concern issue would be plans to borrow money, sell assets, delay, reduce expenditures, plan to increase ownership. Federal government can borrow at the risk-free rate of interest apparently forever because they have $20 trillion of debt. Back then it was only $5 trillion. Now it's 20-something trillion. And they continue to borrow, so the federal government can borrow. That'd be a mitigating factor. How about the ability to raise revenue at will? How would the federal government raise revenue at will?
Bonds?
No, that's borrowing. Bonds are borrowing. They're not revenue.
Oh yeah, I'm tripping. Taxes?
Yeah, just tax. Just increase the tax. You want more money? Increase the taxes. There you go. And pay. You pay. Right? Okay. So we found those mitigating factors, and I jumped off of that assignment before it went all the way down to the bottom of the ocean by begging. That was the only time I ever begged to get off of an assignment. I begged to get off of this going concern one that I somehow got stuck on because I realized pretty early this is a no. This one's going nowhere. And eventually, after the guy snuck the tax return out, this assignment went down to the bottom of the ocean. Okay, but anyway, what happens? Mitigating factors, you have to have both the intent. The intent is fine, but you have to have what? The ability to carry out. And, the ability to borrow money when a company is experiencing these negative trends and all that, or raise equity, buy stock in a company that's having negative trends. So they may sound easy, but they may not be easy to do for a company that's exhibiting these admits fine. And so they have to show the ability to carry those out as well as the intent. Okay. Now, after considering management's plans about the substantial doubt, the auditor may determine that the substantial doubt concern has been alleviated, but that does not preclude the auditor from should consider the need for disclosure. The auditor doesn't have to put anything in their report, but the auditor may now wish the company to disclose some of the matters that were giving the rise for the auditor of the going concern, because it could still be significant enough that they need to be disclosed, whatever they are. Okay. Now, if the auditor determines that there is a going concern, okay, let's just take a look at the reporting for non-issuers. The determination of wording depends on whether the substantial doubt has been alleviated by management's plan. If the going concern base of accounting is appropriate and substantial doubt has been alleviated based on management's plan, the auditor is not required to include an emphasis of matter paragraph. Okay. If the going concern base of accounting is appropriate and substantial doubt remains, then you have to include the words substantial doubt and going concern. Flashcard that. So there's the emphasis of matter, and it has the words what? Going concern and substantial doubt. So if it's alleviated, you don't have to alter your opinion. If it's not alleviated, then you're going to still prepare the financial statements on the going concern basis. Okay, so again, you don't start listing assets and whatnot at their liquidation value. You would still use fair value in that, but you will have to add this emphasis of matter paragraph to your report saying that there's substantial doubt, have to have those words about the entity's ability to continue as a going concern. For issuers, it's an explanatory paragraph, but notice still going concern and what? Substantial doubt are words they have to show. Have to be included in the explanatory paragraph. Okay. Okay, good. Let's go ahead and let's flashcard the documentation requirements. I almost always ask you flashcard documentation requirements. One, so you remember that that has to be documented. And two, it is generally a very nice summary of the area. Okay, so what happened? What were the conditions? The conditions would be admittance fines. What were the mitigating factors? Okay, audit work to perform to look at management representations to determine if they can effectively implement the mitigating factors. Auditor's conclusion about whether or not the substantial doubt has been alleviated. And then what was the effect on the report, the financial statements? I asked them to disclose. Because it had been alleviated, though, I didn't add the emphasis of matter paragraph. I asked them to disclose these issues. They did, and they were important enough that I felt it was necessary to add the emphasis of matter, the explanatory paragraph. Okay. All right, guys, let's go ahead and let's flashcard one more thing here. If an auditor's judgment, the entity's going concern, disclosures are inadequate. Disclosures are inadequate means what? Qualified or adverse. Management is unwilling, and so we now are having a scope limitation. When you see the words management is unwilling with a lot of things, that typically leads to what? Qualified or adverse opinion, unless the auditor can perform an alternative procedure, right? If the auditor's doubt about entity's ability to continue as a going concern are removed in a subsequent period, then you do not have to continue to carry that emphasis of matter explanatory paragraph in your report. So I am auditing 2021, and they're having some problems. The pandemic is still affecting them, or I'm auditing 2020 and things aren't looking too good. I add the what? Explanatory paragraph. It says the matter about substantial doubt of going concern. Then in 2022, we turn the corner, things 2021, whatever, we turn the corner, things reopen. Oh, okay, the concern is alleviated. Even though I may be preparing comparative statements, I don't have to put that going concern paragraph in. The going concern paragraph pertains to the current year, and I don't have to worry about including it, even though I maybe had the doubt in the prior year's financial statements. Okay, and the auditor should communicate going concern to those charged with governance. They should know that, but they want to make sure that sometimes you talk to boards of directors and they're asleep at the switch, right? I think I told you the story when I was doing an audit of the House of Representatives Child Care Center, and they started to liquidate their T-bills to operate. And, you know, when I called the board of directors to ask them if they had authorized the liquidation, because that's an investment, high-level decisions, right? Should go through the board of directors. They said, oh, they have T-bills? Okay, so sometimes you run into, what's a T-bill? You know, you start running into those kind of responses, then you know that you might have to have a little more communication with the board of directors. Okay, good. Let's go ahead and let's take a look at our next question. Okay, stop, guys. What were the 2 words I told you had to be in there? The 2 phrases I told you had to be in there. Stop. Look here. What are the 2 phrases I told you have to be in the explanatory paragraph emphasis of matter?
Substantial and going concern.
Substantial doubt and going concern. Okay. So when it says to you the audit report is required, then it must be very much limited to what I asked you to flashcard has to go into the emphasis of matter explanatory paragraph, which are the words what?
Substantial doubt and going concern.
Substantial doubt and going concern. So going concern, yes, yes. So this is either what? A or C at this point. It's not D because it says no to going concern. It's not B because it says no to going concern. And I don't see substantial doubt in the other column. I see this nonsense about reasonable period of time not to exceed 1 year. That is sort of what we use as our time horizon for a reasonable period of time, but we don't say that. We say substantial doubt and going concern. So the answer is what? C?
Yep.
Question? Okay, good. Let's go ahead and let's take a look at accounting estimates. Okay. And when you have an accounting estimate, what was the word that we always saw that went along with estimate?
Recalculation.
Recalculate. Good. That's the procedure. Recalculate. Right? Okay, so let's take a look. And they talk about fair value estimates, and they tell us that fair value estimates can apply to a lot of different things. Okay, let's understand the auditor's responsibility. Okay, and guys, every time you deal with an accounting estimate, I don't care if it's a fair value estimate, I don't care if it's the estimate for the allowance for doubtful accounts. I don't care if it's the estimate of the correct amount of depreciation for the period. You're going to assess management's policy for developing the estimate. That's always step 1. Flashcard that. Okay. Then what? Verify that they have made all the estimates. Include that on the flashcard. Step 1, assess management. Verify that all estimates have been made, and then the auditor is going to do what? The auditor is going to, and they go on and on here with audit procedures that go beyond what we need to worry about. Develop what? An independent estimate. What do you call that, Matthew?
Recalculation.
Recalculate. I mean, it's not saying it, but that's what we're doing, right? And then you compare that recalculation to what management had and see if you agree. Okay. And then one last step would be to, oh, they didn't put it here, so I'm going to just write it in. Oh, here it is. Evaluate, I missed it. Evaluate subsequent events. Okay. Again, since you've got a little time from the end of the year to when the financial statements are issued, if during that time information comes to your attention that yields a better estimate, yeah, go for it. You've got a little suspended animation going here. The financial statements are dated December 31st. Your report's not coming out until February, and in January, we find out the reality behind something that was an estimate at 12/31. You go ahead and use the actual outcome of that transaction rather than the estimate. Okay. Okay, good. We don't have to go through that. They went on a bit here. Okay, let's talk about misstatements now. Let's get into module 8. Okay. So what happens? You've done all these procedures. We talked about all these accounts. We got into these administrative things, talking to the client's attorney, blah, blah, you know, happening toward the end of the audit. and now you have identified your misstatements, and maybe you've identified some internal control deficiencies. So how are we going to look at those misstatements to determine if we need to modify our opinion, and what is our responsibility to communicate internal control deficiencies? Okay, so let's just start with misstatements. Okay, misstatements discovered in an audit, identification of misstatement, and they start telling us that auditors should accumulate misstatements identified during the audit, other than those that are clearly trivial. Okay, and clearly trivial is not the same as not material. Trivial are inconsequential of size, so that even if they accumulated with other trivial misstatements, they would still remain trivial. Okay, so in other words, they're giving us some clearance there that we don't have to sit there and chase down every 5% error, right? Okay, now you come over and the auditor must evaluate, and now we're talking about the non-trivial misstatements. Okay, so the auditor must evaluate the materiality of misstatements found during the audit, and we consider both quantitative and qualitative factors when we're considering the misstatements, when we're evaluating them. Okay, now you come over to the next page, and as misstatements aggregate and accumulate, the auditor should consider whether or not it looks like they will exceed materiality levels. Now they tell you to consider that, and you start asking yourself, well, how close to my materiality levels do I have to get before I start to freak? Because there could be undetected misstatements. And the way we protect ourselves, going back to our discussion of audit sampling, is we have an allowance for sampling risk, don't we? And so we start to put a precision around that. And so as we start to go over, after we've considered that precision for the allowance for sampling risk, we start to go over that threshold. That's when we start asking for adjustments and whatnot. So even though they say the auditor should consider it, we have statistical methods that will allow us to determine whether we've exceeded our materiality levels through having these cushions, these allowance for sampling risk that we put around our audit sampling outcome, our audit sampling estimate. Okay. Now, prior period misstatements may affect the financial statements of the current period. And so I always point out to my students that if you know remember that example that we had in the audit sampling chapter module, where we did the dollar unit sample, and remember the tolerable misstatement was 18,000, tolerable misstatement was 15,000. And then I believe the misstatement that went from applying our dollar unit sample was something like 8,000 something. What was it? 8,250 or something like that. Good thing that I can't remember the exact number. Okay, but remember I said, well, look, we're below our tolerable misstatement, right? But that wouldn't mean that we don't want to correct those known misstatements for those transactions, ask for an adjustment around those, because if those continue to linger in the financial statements, I think there was one that there was a misstatement for the whole dollar amount. It was like $4,900 or something, and the correct amount was zero. Well, that $4,900 will stay there as a misstatement forever if you don't get it out of there and adjust that, right? It'll sit on the balance sheet forever, and you're never going to collect that, right? Because they already determined it was zero. So, oh man, I built myself all up on that, but this is not where they. Okay, so since I built myself up, I'm going to come back to this page. Go over to the next page, and my conclusion of my wonderful speech will come up, which is right here, number 3. So pretend it was right there. The auditor may request management to record an adjustment, need to correct all factual misstatements. Okay, and other than those clearly trivial, okay? And so, yeah, I think you would in that case ask, even though we were below our tolerable misstatement, right? And we used audit sampling techniques, we had an allowance for the risk of incorrect acceptance. We did all that. We were statistically valid in what we did. We didn't think we had a tolerable misstatement, but I'm gonna ask them to fix that $4,900 one. Now, if it was a 2-cent error, maybe that falls into the trivial and I say, just let it go. Who cares, right? Okay. But, you know, trivial is a tricky thing, scary thing for me because it's trivial today. Will it be trivial 10 years from now when they keep making that mistake over and over and over again? Okay. Now, whether or not a misstatement is material is a matter of professional judgment. And it would include obviously quantitative, but also qualitative consideration. So even if something is quantitatively immaterial, a qualitative consideration could make it material. Okay. Now, they tell us that misstatements are more likely to be considered material if, and these are getting into things that are probably going to go beyond just a pure tolerable misstatement determination, right? Qualitative, this really is talking more about qualitative factors. They affect trends in profitability. They affect what? Here we go again, loan covenants. Those loan covenants, guys, are a big deal. If a company has a situation where they're going to start getting their debt called on for various reasons, that can have disastrous impacts for the company's ability to continue as a going concern even. And so you would look for errors that are going to affect their profitability, right? Increased management's compensation. These are starting to kind of point to what? Almost fraud risk factors, right? Okay, can be objectively determined as opposed to certain elements of subjectivity. Okay. Okay, good. Flashcard all that. I already asked you to flashcard. I had to hunt for it a little bit. I asked you to flashcard the comment about asking them to correct known misstatements, factual misstatements. And then if management refuses to correct some or all misstatements communicated by the auditor should obtain an understanding of the reasons and should take that understanding into account when evaluating whether the financial statements are free of material misstatement. Okay, so when you look at this whole thing, guys, what they're telling you about misstatements is, whether you realize it or not, misstatements are cancer. Okay, you don't want them. You want them out of the accounting system. You want them out of the financial statements unless they're not cancer. When are they not cancer? When they are clearly trivial. Okay? Okay, good. Let's go ahead then. We don't have to go through this exercise and take a look at the documentation requirements. Okay? And let's go ahead and flashcard the documentation requirements as we always do. What amount did we consider trivial? And I think for public company, the SEC has a very well-defined level of what is trivial, and I forget what it is. It's some percentage that is clearly considered trivial and don't require adjustments. Okay, again, it's auditor judgment, but there is some guidance out there as to what constitutes trivial. All misstatements accumulated during the audit that have been corrected. The auditor's conclusion about whether uncorrected misstatements are material individually or in aggregate, and the basis for that. If there are uncorrected misstatements, the aggregate level, the evaluation of whether the materiality levels for the particular class of transaction have been exceeded, and the effect of uncorrected misstatements on key ratios, etc. So don't worry about the trivial stuff. Everything else, I think you're looking very seriously as to whether you need an adjustment for that. Okay, and you should at least ask them to correct known misstatements, factual misstatements, I think, unless they're trivial, because those in many cases may hang around for a while. And something like that 4,900 is a third of your tolerable misstatement. So it may not push you over this year, but next year, the year after, if it sits there, it could eventually affect that. So, okay, good. Let's take a look at question 1. And you need the poll. Okay, let's go ahead and take your best shot at this one. And let's take a look at the outcome. And yeah, we got a pretty good response here. Okay, good, 90%. Now, when you look at this question, you know, it says which of the following circumstances would most likely cause the auditor to suspect that there's material misstatement existing in the financial statements. So if the auditor suspects that the material misstatement exists, what is that telling you about my risk of material misstatement?
Sorry.
High.
RMM must be up. If RMM is up, what do I want to do?
Lower the detection risk and then increase substantive testing.
Okay, good. Okay, so we're going to look for the answer that fits within that model, aren't we? Right? So assumptions used to develop the prior year's accounting estimate have changed. Okay, well, I'm going to stand and maybe a little corrected here. I think that's driving up RMM. Okay. Differences between reconciliation of control accounts and subsidiary records are not investigated. I know that's driving up RMM. Right? Because that's a control weakness. If you're not making that reconciliation, the client is not, then my control risk is pretty high there. Negative confirmation requests yield fewer responses than the prior year's audit. Well, they're not supposed to respond to negative. So that was just pure nonsense. Managed consults with another CPA firm about complex accounting matters. That might actually do what? Drive down RMM, although that would have to be approved by the board of directors before they consulted with another accounting firm, because board of directors are the ones that hire and fire accounting firms. But assuming the board of directors signed off on that, that would bring down RMM. So if I have to choose here, here we go again, most likely, okay, then what? This is the one. If they're not reconciling their general ledger to their subsidiary ledgers, control risk is going through the roof there, right? And so it would make the auditor feel that there's a misstatement, and the auditor would, you know, respond accordingly by trying to lower detection risk. The assumption used in developing, I guess if you can justify why those assumptions have changed, then that might make you comfortable, right? And take away that increase, whichever one arrow I drew for that, take away that increase of risk material misstatement if the assumptions changes seem reasonable. But I'd want to understand the reason I put it driving up RMM. I don't want to understand, well, why did the assumptions change? But clearly B is a control risk factor, driving control risk up, driving RMM up. Okay. Okay, good. Let's go ahead and take a look at the effect of identified misstatements on control risk. What do you think? If you find misstatements, do you think that you're worried that the internal controls are not preventing and detecting misstatements? If you find misstatements, do you think that you have controls that are not preventing or detecting misstatements?
Absolutely.
Yes.
Would seem so, wouldn't it? Okay, so material weakness is a deficiency over financial reporting such there is a reasonable possibility that material misstatements will not be prevented, detected, or corrected on a timely basis. And if we discovered them through our audit procedure, that's absolutely been the case. And so what happens? Identification by the auditor of material misstatements would that would not have been detected would be an indication that there is a control risk, right? An indicator of control risk. However, the reverse is not necessarily true. The existence of material weakness does not necessarily mean that there's been misstatement in the financial statements. So you may have the weakness. So what? Because you drive drunk, does that mean you're going to have an accident?
No.
No, but the statistics are it's going to happen. That's why it's not legal to do such, right? Okay, so just because you have the weakness doesn't mean there's been the misstatement. If there's been an accident, then they're going to test your blood level for alcohol, right? They're going to check your breath or something, but they're going to consider that. In fact, I think they even say when something like that happens, you know, alcohol was not considered a factor or something, right? Which tells you they consider it. So when you find the misstatement, you say, okay, the weakness is probably there. I'm going to stop with that analogy. If you find the misstatement, you say, hey, the risk is probably there. Just because you have the weakness doesn't mean that there's a misstatement, okay? Now, taking a look, in order to decide whether the misstatements are consistent with the assessment of control risk, the auditor can consider the frequency of the misstatement, the effect on other audits, and the financial statement implications. So if you have your risk of material misstatement set at low, and you design your substantive procedure around a low, and then you start finding a bunch of errors, that's telling you what? My assessment's probably not very good. So you'd probably at that point increase your risk of material misstatement and alter the timing, extent, and nature of your substantive procedure now by using more external evidence, using larger sample size for your substantive testing, doing year-end testing instead of interim testing. Okay, flashcard that. Okay, if inconsistent audit risk model should be reassessed and the implications on the entire audit must be considered, which is basically what I just said. Okay, okay, good. Now you come over and they start giving us ideas of the control deficiency in design and failure in effectively design controls. And you start taking a look here, lack of appropriate controls, segregation of duties, lack of appropriate qualifications, okay? And even if you have a good design control, if management overrides it, it's not going to do as much good, is it? Okay, okay, good. Now, when you come over, they start talking about adjusting journal entries, right? Because when you find a misstatement, you're going to want them to fix it. And the way they fix it is adjusting journal entries. Good independent review. I'm going to ask you to do this on your own, guys. You don't need my help to figure out, what's going on here. But you should review this, because I had a dream that the CPA exam could very well ask you to make adjusting journal entries when there's a problem. Okay. And so, for example, if sales was overstated, you're going to have to debit sales and credit the accounts receivable, right? And so on. I'm not going to say that I'm not going to go through this and then go through it. Okay, so go through this, understand this example. All of this is a good independent review. You don't need me to sit here and walk you through how to correct basic. And by the way, they're not going to ask you, give us the adjusting journal entry for the, accrual of a loss for a available for sale security. It's not going to be that kind of stuff. It's going to be basic accounting. There's been an error. How do you fix it? Review that before you go into your auditing exam. You can you'll see a few questions on that. You can understand that on your own. Okay. All right. Good. Let's go ahead then, and let's take a look at this question. That was the last poll. Let's look at this one. Okay, guys, let's look at this one. The reason I'm stopping you a little earlier is I don't recall there being anything that talks specifically about PCAOB standards here. And so that in and of itself could start to mess you up a little bit. And then they say, which of the following is a qualitative, is not a qualitative issue. Okay, so you look and they start giving us these things, but the dollar amount of an error is what? Is that qualitative?
No, it's quantitative.
That's quantitative. I don't have anything else to say. Other than I don't recall them calling out PCAOB in the body of the text there. Okay, maybe they felt it wasn't necessary because obviously dollar amounts are not quantitative. I mean, are not qualitative, they're quantitative. Okay, good.
I had chose C because the cost of the correction also cannot be qualitative, right? That would be quantitative as well, correct?
No, that's qualitative. The cost of the correction is a qualitative consideration. That's why they have things that, you don't necessarily have to correct. So no, the cost of correction is a qualitative consideration. Quantitative means how does it affect the financial statements?
Okay, I guess, that makes sense. I guess I'm confused. There's qualitative and quantitative. I was looking at just the pure dictionary definition of those words in that.
Yeah, even though you're thinking a dollar amount, so you're thinking that's quantitative. When we talk about quantitative, we're really talking about how it affects that there's a material misstatement
That makes sense.
from a dollar perspective. Yeah, but not the cost of correcting it. It's confusing. It's tough. Quite, you could easily pick C, but I understand why C is not correct.
Gotcha. Thank you.
Yeah. Okay. All right. Good. Let's take a look at number 3. Who's my one? Who's my one person? Okay, good. All right, so let's take a look at this one. I started calling for a little early because I'm supposed to give you 2 minutes, okay? But let's go ahead and look. Yeah, okay, good. We had a good response on this one. Now let me ask you a question. What is the objective of the audit?
Identify material misstatements.
We're trying to find material misstatements, aren't we? And we issue our report stating that the financial statements are free of material misstatement, in our opinion. What do work papers do?
Basically document our findings as evidence to back up our opinion.
Okay, so we want evidence to back up our opinion. Excellent. Okay, and so what happens? If that's the case, then do you think you want to document the errors, the misstatements that you found in a summary of uncorrected errors and document the conclusion that they do not cause the financial statements to be misstated? Yeah, I would think so, right? Since your opinion is supposed to be saying whether there's material misstatement. But let's look at the other ones. Do not summarize uncorrected errors in work papers and do not document the conclusion about whether the uncorrected errors cause the financial statements to be misstated. So where's your support for your opinion if you do that? Summarize the uncorrected errors in the work papers, but do not document where the errors cause the financial statements to be misstated, really? And then you're going to issue an opinion with no documentation as the conclusion about why there's not material misstatement for uncorrected errors. Document the conclusion that the errors do not cause the financial statements to be misstated. Do not summarize the uncorrected errors in the work papers. Okay. So just go ahead and talk out your ass. Okay. All right. So I excuse my crude, terminology here or whatever, but I'm just trying to emphasize by talking that way, again, you got to apply sometimes just common sense to some of these things. What am I doing here? Why am I on earth as an auditor? It's to tell whether there's material misstatement in the financial statements and to document what I find. Okay. Okay, good. And I had you flashcard the documentation requirements, by the way. So once you get that flashcard digested, you'd be in good shape. Okay, good. Let's look at the management representation letter. Okay, we've kind of been alluding to it throughout the discussion. I think I said way back when we were talking about engagement letter, that engagement letter comes at the beginning of the audit, and then the management representation letter comes at the end of the audit. Okay, and so what we're doing with this management representation letter is we're asking management to attest to us certain things that we consider critical matters to the audit. Okay, now there are some very basic things. Financial statements are free material misstatement. We make that, put that in a letter that they then hand to us. Now, with a management rep letter, by the way, I was on an engagement one time where it was a very small entity, and I wanted them to sign the management representation letter, and they got all huffy and said they weren't going to sign it. And sometimes that happens because they don't quite understand what's happening. You know what you want in the rep letter. So you're going to take the letterhead of the entity, you're going to print the management rep letter on there, and then you're going to say to them, here, sign this. They'll probably ask their legal counsel to look at it or something, but it's an administrative step that has to be done. Now, in that letter, we have to have them put in there, or we'll just put it in there for them when we print on their letterhead, that they are responsible for the financial statements, they're responsible for the internal control, yon. Okay, we keep making them say that over and over. The part of the management rep letter that's a little more interesting for us is we start covering our, covering our asses. It's a CYA step for things that are hard to audit. We start asking them, you told us about everything, didn't you? Your ability to hold held to maturity securities to maturity. You can do that, can't you? And you intend to do that, don't you? And things that are hard to audit. If there was fraud, you told us about it, didn't you? Things that get difficult to audit, we also start including that management rep letter. It's a CYA cover yourself step. Okay, now it comes towards the end of the audit. It is the final piece of audit evidence, and it is dated the same day as the auditor's report. So it's the last thing we get from them that we're going to include in our work papers. Okay. Notice the letter is mandatory. Okay. And the older I get, the more I start having auditing flashbacks. Because I was thinking when I was looking at this earlier today, I wonder what I would have done if that person would have continued to refuse to sign the management rep letter that time. And then I started imagining how they would have ended up blaming that on me at some point. The reason she doesn't want to sign it is because you screwed something up, John, as opposed to she just didn't understand what it was. But I was able to be nice, believe it or not, and get her to finally sign that. Okay, so the auditor must receive the letter in order to get an unmodified opinion. Okay, refusal to furnish such a letter results in a disclaimer of opinion or a withdrawal from the engagement. And the standards always saved me, because I would always get some people that would start to support the entity we were auditing and saying, well, you're being unreasonable in asking them to sign this thing and stuff. And so I'd always have to go back to the standards and say, guys, I'm asking them because the standard says we're supposed to do this. And that got me off the hook sometimes when maybe a manager or something was starting to get a little dumb. Okay, now what happens? I already said this, it's dated the same date as the auditor's report. So we already said that, okay? It is signed by high levels of the organization, okay? So it is usually signed by the CEO, CFO, and flashcard that. Okay. Now you come over to the next page and they start with a laundry list of the contents of the management representation letter. And there are some obligatory things in there. They're responsible for the financial statements. They're responsible for the internal control. Yeah. Okay. But the ones that I find more useful for us are these down here. And if something is hard to audit, then we will likely have them include that in the management rep letter. Okay. So you can go ahead and flashcard these things. These up here are high level, almost no brainer things. Okay. And then when you get down to these, and you can just flashcard a bunch of these are more, I wrote it over there, but these down here are more hard to audit, but flashcard all of them. Okay. For example, completeness of information. The assertion that scares us is completeness. Existence is what? Okay, there's something that's in the financial statements. My job is to go see if that thing exists. And I'm limited to what? The, square of the financial statements, right? Completeness, I have this square, and then there's a whole world that maybe should be in there, and I don't know if it is. So completeness is the more scary, the more difficult assertion to audit. Therefore, we have them put in the management rep letter. You gave us complete information. Okay. Then what? Fraud is hard to audit. Why? Why is fraud hard to audit?
Because they're going to try to cover it up.
Yeah, they're going to take steps. They're going to think through, and they may be slicker than we are. Auditors don't walk around thinking that they're slicker than everybody else and the client's never going to get one past them. Auditors live in fear that somebody's going to, throw a curveball on them that they miss, right? Okay. Laws and regulations. Management should know what laws and regulations are subject to their business. And they should put in the management rep letter that they've informed us of those important laws and regulations. Okay. Coming down. If there are uncorrected misstatements, you told us about them, didn't you? Litigation claim and assessment. We start with management. Hey, you tell us. You should know whether you're being sued. Estimates. Hard for us to necessarily come up with that recalculation, independent estimate. So we ask them to say, hey, you've done a good job with your estimates. Who are your related parties? Remember when we found a related party that they didn't tell us about, we got a little upset and started asking, why didn't you tell us about it? Because maybe we thought they were hiding it. Subsequent events, that period between the end of the year when we issue the financial statements is a scary period because stuff could be going on out there that's not being hit in the accounting records of the previous year now. And so we asked them to tell us about that. Okay, so flashcard these, but kind of have that idea is that the management representation letter, which is from management to the auditor, signed by management, but frankly, the auditor prints it out and gives it to the client to review and then sign because we know it has to be covered. Okay, and then they go on and on with a example letter that we don't need to worry ourselves. So we got a flashcard, we got a good way of thinking about this. Okay, good. Let's go ahead. Written communication regarding internal control. Okay, now when we take a look at this, okay, this is when performing an audit, an integrated audit. Okay, this is required for public companies, and non-public companies may request us to give an opinion on internal control. If it's a non-public company and they don't request it, are only responsible for the internal controls to obtain an understanding sufficient to evaluate the design of the control, determine the control has been implemented, and make an assessment of the risk of material misstatement. Once we're done with that, if we assess the risk of material misstatement at the maximum, we'll move directly to substantive testing. If we assess the risk of material misstatement to less than the maximum, then we're going to have to test the operating effectiveness of the controls to determine the time being extended and timing extend the nature, extent, and timing of our further audit procedures, right? That's for a non-public company. For a public company, we also have to report on the internal control, and non-public companies may request that we do that additional work even though we're not required to. Okay, so if that's the case, you're integrating an audit of the internal control along with your audit of the financial statements, then we have to get representations from management regarding the internal control, in which case management must acknowledge their responsibility for the internal control. They're going to say that the assertions and the specific criteria used to evaluate the assertion. This is often COSO, which is Committee of Sponsoring Organizations. The Treadway Commission is the criteria that we generally use. And we talked about that in terms of being the control environment, the risk assessment that needs to be done, then the control procedures that are put into place, information communication, and then the monitoring. We put the existing control procedures last so that it would spell crime for us. That's the COSO criteria that is typically used to evaluate the internal control, and management would say, hey, in our designing the control and evaluating its effectiveness, we use whatever that criteria is, and it's typically COSO, okay? Affirmed that they did not rely on the auditor's procedures. So in these cases, management has to evaluate the control. They don't sit on their butt waiting for the auditor to do it and say, whatever you say about the controls auditors, we say. They are responsible to be actively involved in assessing the controls, okay? If there are significant deficiencies and material weaknesses in the control, which have a specific definition that we'll get into later, then they have to tell us that, they've corrected those or they remain unresolved, describe any fraud, and state whether there have been any changes from the as of date of the report to the actual issuance date of the report. So the as of date is typically the year end, and then the date that the report is issued is usually sometime after year end. And if they have control problems, we don't want them to sit around saying, well, hurry up and issue the report, because those control problems still have to exist at the date of the report. When the report is issued, we could have them correct that. And then since now they're not issuing that report until, say, February, they may want to say in there, hey, well, we've already corrected this, and that's okay. They can say that if they've done that, okay? Failure to obtain the written representation on the internal control. Again, these representations are pretty important. Result in withdrawal or disclaimer of opinion. Okay. Okay, let's go ahead and let's take a look now at this question. I feel like we have a lot of number ones today. Seems like we typically are having one question per section here. Okay, guys, let's take a look at this one. And most of us got it right. No, no. Most of us missed it. Not most of us, but the largest percentage of us missed this one. Okay, so let's look at this one. Okay, this is 45% chose D, and D is wrong. Okay, so let's take a look. Most of us chose D, 45%, and D is wrong. Okay, so let's just take a look. And which of the following matters would an auditor most likely include in a management representation letter? Okay, so the first problem here with this question that made probably A confusing said, what should an auditor include in a management representation letter? The management rep letters from who to who?
Management to the auditor?
Huh?
Management to the auditor.
Yeah, it's management to the auditor, exactly. So this question really shouldn't say would the auditor include. It's what the auditor would ask management to include in the management rep letter, or management should include in the management rep letter. This question maybe got written by an experienced auditor who was doing what I said, was just printing on their letterhead. But it's officially from management to the auditor, right? So if it's from management to the auditor, would the auditor be talking, would management be talking to the auditor about communications with those charged with governance concerning weaknesses in internal control? No, if there are weaknesses in internal control, we're going to see in a minute, that's something that the auditor would want to make sure is reported to those charged with governance, but we don't expect them to put weaknesses about communications that they had with their board of directors in the representation letter they send to us. We don't need that. Okay, good. Talk to those charged with governance all you want, management. You don't need to run. It's not like, you know, little kid every time they have to go, I have to go to the bathroom. Oh, okay, go ahead. Don't tell us about it, right? So they don't have to tell us that, you know, they, you know, talk to those charged with governance. Fine. Talk to them all you want. Okay. B, the reasonableness of significant assumptions used in making accounting estimates. Yeah, that was right on our flashcard. We want them to be reasonable about how they make their accounting estimates. And since it's difficult to really decide, you know, that they're doing a good job with the estimates, we ask them to put that in the management rep letter. C is nonsense. I don't think anybody put that in, because that's something that's going to happen in the next year. We'll deal with that next year. Why would they be putting that in this year? D is the one that a lot of us chose as well, though, and that one's a little bit confusing. Management's acknowledgement of its responsibility for the detection of fraud. Nobody in the world can tell you, I am responsible for detecting fraud. We can give what? We can give assurances that we put programs in place to detect fraud, but management's not in a position to say, I'm responsible for detecting fraud. Oh, you are? Okay, well, you know, you had a genius working for you and they got the fraud past you, so you're in trouble now because a genius was able to perpetrate some fraud on you. So they're not going to sit there and say that they're responsible for the detection. So you say, well, what was that about fraud in the management rep letter? And if you look there, it says that they are responsible for implementing programs to prevent, deter fraud, but they don't say that they're responsible for detecting the fraud. They put reasonable controls in place that should prevent or detect it, and then they pray, just like everybody else. Okay? Question? Okay, good. We got a flashcard around that rep letter. Good. Let's finish module 10. And I think it's okay that we're not finishing. Well, we won't finish module 10. Let's finish this first part of module 10. And then when we get to section 4, we're going to section 5. We're going to save that for next time, and I think that's okay because it actually parlays better into the start of chapter 5 anyway. Okay, so let's just go ahead and let's take a look. Those charged with governance typically means the board of directors, the audit committee. Okay, they use the term those charged with governance because some entities that you may audit won't have an official board of directors. They may have a board of commissioners or something. So the more generic term is those charged with governance. Okay, now it is important that we realize that the audit committee is part of the board of directors, and they are the ones that are responsible for overseeing the audit. Okay, now you come over and the specific functions of audit committees. And again, they select the auditor, they determine the audit fee. Okay. Now you come over communications with the audit committee, and we have to meet with the audit committee without management present at least once per year. Flashcard that. Okay. And then Sarbanes-Oxley. If it's Sarbanes-Oxley, then we're talking about what type of companies? Sarbanes-Oxley Act pertains to public companies and to issuers, okay, and it requires that the audit committee approve engagement of the auditor and pre-approve services to perform and have ongoing communications with the auditor. That's why I said the thing about them consulting with outside accountants for complex accounting matters, that's got to run through the board of directors under Sarbanes-Oxley. They can't just go off and start hiring all kinds of different CPA firms to do different things for management. Can't. The audit committee got to sign off on that. Okay. And so the audit is really overseen by the audit committee, not by management. Okay. All right, good. Now coming over and just looking at some of the required communications, and let's just come down and see what they tell us about significant audit findings. Let's just look right there. Okay, so the auditor should communicate. Okay, let's go ahead and highlight and flashcard some of the key things. The appropriateness of the accounting policies that have been selected by the management, reasonableness of estimates. You see again here, we start going down this path of things that are difficult, and we're essentially now communicating to the audit committee. We're giving a report card on management to things that are more critical, maybe a little more subject to judgment, right? The sufficiency of judgment. Difficulties encountered in performing the audit. Look, we get the audit done on time and all that, but meanwhile, management was very difficult to work with. Their accounting records were in such a case that we had to do additional audit work. That's the kind of thing that the board of directors needs to know. Information and control environment, it's going to work its way down through the rest of the rest of the accounting process, right? Disagreements with management, whether or not resolved. Again, you've got a management that's being unreasonable with you. You may get the opinion out, everything looks great. Meanwhile, the hell and fire you had to go through, that needs to be talked to with the those charged with governance and board of directors, the audit committee. Uncorrected, non-trivial misstatements. Okay, if there are material uncorrected misstatements, what were they? And the auditor should ask for the correction of uncorrected misstatements. So, you can ask if they don't have the information to correct it, what are you going to do? But if management's sort of refusing to correct something that's material and you're getting ready to qualify, the board of directors got the power to come back down and say, get busy and correct that, management. So you'd want to make sure that you've at least tried to get that corrected through the board of directors by communicating to that. Any circumstances that might bear on your independence. Okay. Now, coming down, and let's make a separate flashcard out of this. So I asked you to flashcard those things we highlighted up there. If those charged with governance are not involved with the management of the entity, then we should also communicate significant findings during the audit that were discussed with management. material corrected misstatements brought to management's attention, management representations requested by the auditor, and management's consultation with other accountants. Again, everything goes up. Board of directors got to know everything. Everything goes up to them. So if there's things that management would be aware of that the board of directors would not, then you have to make sure they know of those things. Now, everything goes up, not everything comes down. Okay, so what happens? Certain matters communicated to those charged with governance may not be something that is for management's consumption, such as issues related to their integrity, their competency, etc. You may not want to share that with those charged with government. You will share with those charged with government, but you may not want to share that with management. Okay, good. Additional requirements for issuers. And in addition, auditors of issuers should discuss and provide the draft of the auditor's report prior to its issuance. And I thought about that today. I'm like, really? Is that right? And I'm like, yeah, okay. Why should there be a surprise that, those charged with governance don't know that there's going to be some sort of qualification or something until it's published? Yeah, I would share that draft with them, make sure they're aware of that. Okay, that's what we're required to, and so I would do it. It seems reasonable. Okay, all right, good. Now the form of communication, okay, does not have to be in writing. So make sure you flashcard may be oral or in writing, because sometimes they'll give you a good, those charged with governance communication topic, but they'll say it has to be in writing. Okay. If there are oral communications, however, they need to be documented. So it doesn't have to be in writing, can be oral. If you're going to, just do an oral communication, you have to document that you've done the communication. And the timing of the communication may vary according to circumstances, but should be in a timely manner. And we're going to talk more about the timing of communication for internal control issues, because those requirements are very specific, and we're going to start here next time. So I apologize that I'm leaving you a little bit short to complete the module 10 here. If you see things about internal control communication, do your best on those, knowing that we're going to cover that next time. And we're going to jump into the procedures that are required when you do an audit of internal control that is integrated with an audit of the financial statements at the start of chapter 5. Questions? Okay, guys, if there are no questions, we're going to roll, and I will see you on Monday. I think you got plenty of work cut out for you this weekend, so make sure you're making good progress on this stuff, okay? You guys still
All
there?
right, see you next week.
Okay.
Thanks. Have a good weekend.
Yeah.
Bye-bye, guys.
Good night.